Welcome to weekly view on markets. This week Nifty has closed at 17,327 after a volatile week. We have also seen sharp cut in Nifty after the rate hikes in US. Nifty has closed with a loss of 1.16% for this week. Bank Nifty also closed with a loss of more than 3.02% during this week. Mid cap and small cap also ended in red with a loss of 1.3 and 1.6% for this week. India VIX, that is the fear index or volatility index, has again peaked, is at 20.59. Volatility index increased by more than 3.8% during this week. The short term chart, that is the daily chart of Nifty, has technically become weak. But Nifty managed to close around the support zone. Let us look at Nifty chart. This is the daily chart of Nifty. The bottom trend line shows the support level. So Nifty has support at around 17,300 to 17,400 level. Nifty has closed just at around the support levels. And Nifty has strong resistance in the range of 18,000 to 18,200 level. Now, whether the Nifty will draw down from here or it will take support and pull up, we'll have to wait for few more trading sessions. The Nifty movement will mostly depend upon the global markets and the global cues in the coming days. Even though the Nifty chart looks quite bad on short term basis, the long term chart, let us look at the weekly chart. The weekly chart of Nifty, if we look at the up move from 7,500 Nifty level up to 18,000, that is after the COVID correction, the rally. And after the rally, last 6 to 8 months, we have seen correction from 18,600 level up to the 15,100 level. This entire correction looks like a consolidation on a long-term chart, that is weekly chart. And I don't see any bearish pattern on the weekly chart. So technically, in the medium period, the chart is not showing any weakness as of now. There is no reason for panic. If we look at the long-term chart of Nifty, that is the monthly chart, this has made a kind of flag pattern which has bullish implications. Now Nifty has closed above this top line. So as long as Nifty remains above this top line, this pattern holds good, which has bullish implications. So both medium and long term, I still hold bullish view on Nifty. Let us look at Nifty mid cap. The mid cap chart on a long term basis is similar to Nifty chart, and as long as the price action remains above this top line, that is cloth of this flag, the long term trend for Nifty mid cap also remains bullish. Now let us look at the small cap index. We will find similar observation on Nifty small cap index. The small cap index still is above the long term support level, that is around 9,200 level. So, as long as this remains above 9,200, small cap index is likely to pull back, and only if it closes below 9,200 then calls for a caution. So this is about the technicals. The main reason for markets correction last week was rate hike in US markets. US Fed has raised interest rates by 0.75%, that is 75 basis point, which is one of the steep hikes in the recent times. And also, Fed chairman has told that they may have to raise interest rates successively for some more time till the inflation comes under permissible limits in US markets. Also, we have seen that the economic growth in US has started declining. So now they have a really difficult problem at hand where inflation is going up and growth is slowing down. So under such circumstances, Fed cannot give any stimulus package like earlier times because the more they pump in liquidity and give stimulus, inflation will rise faster than the growth. So now we'll have to wait and watch how Fed is going to tackle this problem in US. In India, situation is slightly different. It is not all that bad in Indian context. The macroeconomic fundamentals of Indian economy still remains strong. Due to the rate hike in US, the dollar index had touched an all-time high of 112. About a year back, the dollar index was at around 91, 92. And from there, within just 1 year, the dollar index has gone to 112. So this has put pressure on all currencies across the world. But Indian rupee has comparatively performed better than other emerging markets. The bond yields in US have sharply risen above 3%. This makes US bonds very attractive investment at this point of time. So we see the capital moving from emerging markets to US market. This is the reason we are seeing corrections in emerging markets. But India is definitely doing much better than other emerging markets in this respect because the economic growth and also the corporate sector's balance sheet is in much better shape in India. Corporates have deleveraged their balance sheets, and banks and NBFCs have controlled NPS in their books. Their loan books or their asset quality is much better, And also we are seeing credit growth in the banks. Last 5 6 years, the bank's profitability was very badly affected. Now we are seeing a upcycle. Their earnings are picking up, and also we are seeing the credit growth. Capacity utilization of Indian companies is above 70%, and they are going higher. With the festival season coming up, corporates are expecting demand to pick up from here. These all indicators are giving us a idea that corporate earnings in the coming quarters will be much better comparing to the earlier times. But Indian market is trading at premium valuation compared to other emerging markets. This is somewhat justified because among the largest economies in the world, India is leading in the growth. The growth in Indian economy is to be will be much higher than other large economies. The comparative advantage in the Indian economy makes it a very interesting investing destination for all investors. If we take a slightly longer term view, it will be very good to remain invested in good companies in India or in good mutual funds. And I am confident that the investors are going to get rewarded in next 2 to 3 years if they remain invested through these short-term troubles. The historical evidence in Indian market provides us some guidance on this. Nifty and Sensex have gone up by 18 times, a CAGR of 14.5% in last 20-22 years. We have seen so many crises during last 20 years. All kinds of economic troubles, all kinds of natural calamities, so some kind of troubles at the borders, some global crisis. All these we have seen in last 20-22 years. So that is why if we remain focused on long term and ignore these short term troubles, we will make very good returns from the stock market. So this is all for this week. Let us meet next week again. Thank you. So after watching this video, please give your comments. You share the video with your friends and subscribe to the channel. Thank you.